The focus is on earnings. Financials are slightly weak with what happened with HDFC Bank, led by HDFC Bank. Sorbh Gupta is here to talk more about the markets and at Quantum, how they are actually addressing in their portfolio construction, in their schemes. Sorbh, thanks very much for your time. I see that in the fund which you follow, you're overweight on financials. Around 27% of the weight is towards financials. How's your composition of financials looking? What kind of banks do you have? Not the name, but category financials in insurance or NBFCs. How have you structured the financial part of your portfolio, looking at the environment and the fears on asset quality, etc.?
Yeah, thank you, Ajay, for inviting me. As you talked about portfolio construction, within financials, we are sticking to larger names which are well capitalized specifically. We are still clearing ourselves from the tier 2, tier 3 banks because we believe this second wave could throw up some negative surprises on the asset quality, and we want to hold on to banks which have a history of good credit underwriting and which are well capitalized. So we are sticking to larger banks over here. We believe that economic recovery is happening. There are disruptions due to COVID, but we believe overall the way interest rate cycles we've seen it moving. We have seen how real estate cycle is moving. The economic recovery is happening in the country. So banking would be a good play to play that economic recovery because it could grow at higher than nominal growth rates of the economy, especially the private sector bank will gain market shares. But it's better to stay safe with larger banks with good credit history and well-capitalized ones. That's one pocket that we are present. Secondly, we are also present on some specific NBFCs which are catering to some specific sectors which we believe last year because of the market crash, we got some good opportunities to buy into those specific names which have a very strong specialization on special financing needs of special categories, and they have a history of very good credit profile, and they don't have a risks on their liability profile. They are well funded, either backed by a good institution, or they have a history that they can raise capital in toughest of the times. So this is how we have structured the financial part of the portfolio.
Right. I'm keen to talk more about industrials, which is 4.5% of your weight, and even utilities. Now, what has happened is that the entire utility space in India got kind of re-rated because everybody started shifting their business model to renewables, renewed focus, and also, there are talk that the new bill in the power sector will be taken up, which will improve their financials, help to improve the financial of the sector, and also on capital goods. You have relatively lower weight. Are you looking at increasing it? How are you analyzing these two categories?
Yeah, so we are looking at these sectors. One longer term theme, Ajay, over here is that these capital heavy companies have seen underinvestments for more than a decade. So if you look at last 10 years, not much investments have happened in thermal power, which our understanding is that we require thermal power at the peak capacities because solar cannot handle the peak capacities of summer in India. So we need those thermal capacities, and that we have not created enough capacities. Similar in other capital goods and infra space as well. So there are pockets of opportunities where we feel that in this, and government's focus in the budget was clear that they want to focus on power, they want to focus on infra. And over last 7-8 years, the weak hands have moved out. So most of the companies have gone into NCLTs or similar. Only the stronger ones have been left, which have good financial backing, which have good business case, and they have left with great market opportunities. So we believe there is a good opportunity for these companies to gain market share, and with the cyclical uptick in infra and power, we believe that these companies could benefit and earning upgrades could happen faster in these companies. That's the first part. Second part, on the specific of utilities, what we understand is the markets look at things on a very relative basis. So in a very strong dislocation like pandemic, what happens is that in utilities, that 14-15% kind of return is guaranteed and it will come to you, right? So that helps market in terms of predicting the future earnings for these companies, where rest part of the market gets dislocated. So this brings back interest of shareholders or investors into these utilities, and cyclical uptick will also help these earnings. So this is how things are shaping up, and that's why we have positioned. But we are ensuring that again we are on the stronger side of the companies. We don't want to get into companies which have a very high debt or don't have a regulated return business, because the environment is still a little fluid, because we don't know how many waves of pandemic will come, what kind of lockdowns could happen. So we are sticking to companies which can handle these down cycles. So we are not going down too much in terms of our pecking order of picking these names. And that is the reason you see that portfolio weight is a little lower. But we believe that these companies going forward will see good earning upgrade if this economic cycle continues to move up. So that's how we are positioning in these sectors that we talked about.
Right. Sorbh, how are you positioned, or your view on this entire stock market infrastructure, digitization, and the new millennials joining the stock market investors club last couple of years and months? Entire ICICI Securities, angel broking kind of category of company on the one side, the infrastructure providers, exchange stocks, CDSL, CAMs of the world, all of that. This entire 8-10 stocks have got completely re-rated. How are you approaching it? Or you think it is relatively a tactical view of looking at things, but structurally these kind of category of stocks may be very cyclical in nature? How are you analyzing this?
Yes, Ajay, you partly answered the question that we believe it's cyclical, and we have seen these cycles 2006-07 again when a lot of retail investors came in. Then again, one sharp correction, and things just went out of hand. So we have to be very careful in these names when to get into these names. Definitely, it's a structural trend. So we know that India is underinvested in equities. Indians are underinvested in equities. They will require vehicles like mutual fund, or they will try to do it on their own. Doing their own, I would be a little careful, because now what we have seen is that due to this whole digital things, a lot of influencers have come in, a lot of Twitter handles are recommending stocks. So we generally advise investors to be careful, and this is not a new thing. The platform could be different. This time a little more digital. Last time it was maybe some more advisor driven. But these are cyclicals, and once a dip comes and retail investors burn their hand, they generally go away for 2-3 years. I just hope that this does not happen. But the way mid and small rally is happening, I fear that could happen. And these companies could face that cyclicity. So I would be careful in getting into these names from a portfolio perspective. So we are not very seriously looking at these names. Yes, we would be looking at some better names like some of the listed mutual fund names, because we believe mutual fund is a big story to play over in India, and it's, as a percentage to GDP, the investments are still very small, and the cyclicity is lower because they have a good P&L, and most of the listed names are now net cash positive, good balance sheets, and have the ability to gain market share. So we are looking at those kind of stories. More to play this whole wave, but direct to equity kind of digital things, we would be a little careful. And secondly, these fintechs have a lot of money to burn. So I am not sure, because in the listed space, you have to look at profitability, but in this fintech space and startup space, people don't look at profitability. So they can be a huge competition to these listed names. So we have to be careful over there as well. So we'll be a little careful in this space right now.
All right, Sorbh, we'll let you go on that one. Thanks so much for your time. Great chatting today.
Thank you.
Let's take a short break on that note. On the other side, we'll talk about more buzzing stocks and the numbers to watch out for when we come back on 21.